Today on Market Vision, the canaries in the coal mine are starting to chirp again, and October surprises are on deck. So let's talk about canaries in the coal mine for a moment. We are starting to see weakness in pricing again with senior secured floating rate debt, commercial mortgage debt, especially as it pertains to commercial assets. We've talked about these assets in these areas of the market repeatedly. These assets have very low pricing right now relative to the value of the underlying assets. The yields are very, very high. And so for people with risk tolerance, this is an interesting time to consider purchasing some of these assets. But it's going to be a while to wait out this storm, because the real question is, have we just put off the inevitable in terms of the defaults and bankruptcies with regard to the economy with all of the shutdowns? 'Cause let's admit it, first quarter we started shutting down. The shutdowns were in full force in the second quarter, but we also had a mountain of stimulus money. Individuals, unemployed folks, businesses with PPP and EIDL, all of that money came through primarily in the second quarter. So third quarter, Washington could not get their proverbial crap together. And so everybody left town and didn't get another round of stimulus through during July and August. And so now we're coming up on the end of the third quarter. And the big question is going to be, what does no stimulus in the third quarter do for corporate earnings? And that question mark is what's driving the market down about 8 to 10% right now. That's what's causing some of the fits and starts on the technology indexes. And that's what's causing the canaries in the coal mine, those bond prices, to come back down a little bit. They're not back at all-time lows. They're not retesting those lows from the March timeframe, but they have come up kind of off of their recovered highs. So we're watching that really closely. If you are concerned, please don't hesitate to reach out to us. If you have cash flow needs in the next 3 to 6 months, we probably want to raise that cash now. So please let us know about that. And then we want to be greedy when we see opportunities. So if we see some assets that plunge in value here, some sectors of the market that plunge in value, we want to just be greedily acquiring more shares, because ultimately that's how you build your wealth, is accumulating more shares when the prices are depressed. Use the cash on the sideline that you don't need in the near term. Use the cash flow from your portfolio and use those assets when the opportunity gives us occasion to move assets into the market and acquire more shares for what we expect will be a rebound post-election. And again, we're not taking positions on who should win or who will win the election. The market doesn't care. The one concern, the one asterisk I would put next to that is that if we have a protracted non-event where we come out of election day and we don't know who won, or we get some kind of a constitutional crisis, that's probably worse for the market than either one of these guys winning, at least at the presidential level. But get ready. We're in the middle of crazy season, and October surprises are sure to abound on both sides. Everybody's going to have a surprise, and this time, everyone is going to say, this time it's for the soul of America. Right, left, blue, yellow, purple, red, whatever. It doesn't matter. Let's get through election season, get through the storm of the cacophony of October surprises, and look forward to better days and smoother sailing as whoever wins starts to figure out their administration and their decisions for 2021 and beyond. If you have questions, don't hesitate to reach out. We're always here with perspective for the decisions ahead. Have a great day. Have a great week. Enjoy the changing of the season here this week. Happy fall. Take care.